Hi, thanks for watching. Today I'm going to go over my repo financing workstation for the CTD basket. It could be a hypothetical one. I'm just going to give a quick overview, then go over the steps. So the general purpose of this spreadsheet is you're going to compare the fair value or ideal cheapest to deliver and its net basis versus the market traded cheapest to deliver and its net basis. And I'm doing this to dive into the nuance and technicalities of how does a cheapest to deliver basket work? How does its financing work? How do you determine what the cheapest to deliver is? And how does the market react? Does the market stay with it? Does the market not? I'm going to note this is not a desk-ready desk physics sheet, and it's not 100% made for trading. Instead, it's more of a quant finance project to start learning about how does the cheapest to deliver basket work. So I'm going to get to the first part of this, which is your inputs. So right here, we have you pretty much put in the market for the front contract, the market price of the front contract futures. And here you have up to 25. So I made it a basket that's large enough like a real basket. Like if you look at the ZB baskets, you'll have 21, 22 deep bond baskets sometimes. So here I have an example of 7. So you input the CUSIP repo. Here this is a special repo situation. This is a hypothetical example, so you see a lot of varies. Conversion factor, days to delivery, the par of the bond, the clean price, your rate, that would be yearly, your frequency per year, cents, meaning days since your last coupon, and your period, which is typically going to be 182. That's how many days in that frequency period. And first of all, what it helps is it gives you your cash bond outputs. So it shows you your coupon payments here. If you get paid twice and the rate is 2, it's going to be 1. And you get your accrued interest since that last coupon payment to give you your dirty price. So this would be the price of the cheapest to deliver without its accrued interest. This would be the price with accrued interest. So after a coupon payment, you sometimes see a bond readjust for that accrued interest. You have your financing outputs. This is your projected accrued interest. So this is how much accrued interest is projected to occur from now till the day of the delivery of the futures contract. This is your repo cost. So this is the cost to finance the bond at its special repo. It can be negative or positive depending on the carry. Like some bonds have these have negative carries, but other instances it will be positive. Finally, you get your fair value output. So you have your fair value price, your converted price. So that would be the price times that conversion factor. So you can kind of think in scales of the dirty price. You have your invoice, which my calculations is the converted price plus projected accrued interest. There's different textbook ways to do it, but that's the formula I'm following. You have your gross basis. And again, because I'm using a repo adjusted, like if you go to the price here, you would see I'm using the dirty price plus cost minus the repo cost. And that I'm using a repo adjusted fair value formula. So the outputs of invoice and converted are a lot more intuitive. So this gross price is the converted, is the dirty price of one of the bonds minus the converted, and the invoice is plus accrued interest. Net basis is what you're really looking here. So in this basket, the ideal cheapest to deliver by its net basis would be bond A. I didn't do any complicated concepts here. And that's because it has the lowest net basis or the lowest dirty price minus invoice price. And that would be the best economics in my model, not this is an objective model for the deliverer there. And then this next one is we put in the market futures price. So let's say we were looking, this is ZN contract, we were looking at this and this was the market price. Now we would, that's going to input all the way here, and we convert those prices once again. We do the same formula for invoice. You get your gross basis, and you'll see the most negative net basis for here, and it's a hypothetical example, so it's radical numbers, is bond G, and that has a very large 7.69 point negative net basis from the dirty to the invoice price, and that would have the best traded economics. And I gave this example to show that not necessarily does the ideal cheapest to deliver ideal net basis equal what's happening in the market. And I express this here with the most important output table is we look at, we look at the lowest net basis traded by the market, which is 7.69 points. You look at the low fair value, which is 1.3, and you see there's a difference. You see there's a difference of 6.38 points, and we're trading incredibly cheap. Now, this is a hypothetical example, and it's radical, but it's really showing, like, even when you take inputs like special repo, different rates, different periods, and times when coupons were handed out, and you look at it, not always are you going to have a situation where that bond A, ideal cheapest to deliver, is the market traded. And reasons it can trade cheap are varied, and sometimes it can even just be straight up liquidity. It could be just hedging in different dynamics. Sometimes it's related to inflation or Fed expectations. But this is my workstation that I can use on those Wednesdays when the Mercantile Exchange puts out baskets. I can help better understand in real time how is our ideal financing versus the market trading observed cheapest to deliver interacting, and are we having a situation where treasury futures are trading rich or cheap? And I hope to build upon these concepts to add ideas like convexity, shocking these, adding basis points and repo shocks to it, and eventually yield curve and relative value trading. Thanks again for watching, and I'm continuing my series of posting my quant projects.